Meet Jake and Marcus. Both are 32 years old, both live in America. Both earn $85,000 a year. For 4 years, they skipped the vacations, drove used cars, said no when everyone around them said yes. And today, they both have $100,000 saved. Same money, same starting point, two completely different plans. Jake believes real estate is the proven American path to wealth. His parents did it. His neighbors did it. He is convinced. Marcus thinks differently. He wants his money working silently, automatically, even while he sleeps. So today, we follow both of them for the next 20 years. And I promise you, the result will surprise you. Let us begin. Jake takes his $100,000 and uses it as a 20% down payment on a $500,000 rental property. A solid house, good neighborhood, growing city. He takes out a 30-year mortgage at 7% interest. His monthly mortgage payment, $2,661. Within 3 weeks, he finds a tenant willing to pay $3,200 per month. On paper, Jake is making $539 every single month. He calls his friends. They are impressed. He drives past the house after work, looks at it, and quietly thinks to himself, "I own that." Marcus takes the same $100,000 and puts it into a total U.S. stock market index fund. No mortgage, no tenants, no late-night repair calls. After his monthly expenses, he still has $400 left over. So he sets up one simple automatic investment, $400 every single month. Then he closes the app and gets on with his life. Nobody asks Marcus about his portfolio at parties. There's nothing exciting to show, no house to drive past. Just a number quietly changing on a screen. Day 1, Jake looks like the clear winner. Marcus just looks patient. 3 years pass. Let us see where they actually stand. Jake has collected approximately $115,000 in rent. His mortgage payments total around $95,000. On paper, that looks like $20,000 in profit. But then, reality arrives. Property taxes in most U.S. states, $6,000 per year. Homeowners insurance, $2,000 per year. Maintenance costs, 1 to 2% of property value annually. That is $5,000 to $10,000 every single year. Then, 1 month, the tenant leaves. The property sits empty. That is $3,200 gone, just like that. Then, the HVAC system breaks down. $4,500 repair bill arrived on a Tuesday morning with absolutely no warning. Jake also manages the property himself to save money. That means late-night phone calls from tenants, weekend inspections, chasing contractors during lunch breaks. By the end of year 3, that $20,000 paper profit, in reality, it is closer to $3,000 to $5,000, and his time is still not counted. But here's Jake's secret weapon: leverage. His $500,000 property is now worth approximately $550,000. Every single mortgage payment has been quietly building equity in the background. His total equity has climbed to approximately $160,000. He used $100,000 to control a $500,000 asset. That is the unique power of real estate, and it is something the stock market simply cannot replicate. Marcus, meanwhile, has had a very different 3 years. No drama, no repair bills, no difficult tenants. His $100,000 investment, plus $400 added every single month, growing at the stock market's long-term average return of 10% annually, his portfolio is now worth approximately $155,000. Zero phone calls, zero stress, just quiet, consistent, unstoppable growth. 5 more years pass. Now we are at year 7, and something important begins to happen. Marcus's portfolio crosses $240,000, and compounding starts doing something most people never see coming. His investments are now generating more growth each year than his own monthly contributions. Every dollar is making new dollars. Those new dollars are making more dollars. This is where the stock market quietly shifts into a higher gear. Most people miss it because it feels completely boring from the outside. Jake, meanwhile, has now dealt with 3 different tenants, 1 roof inspection, 2 plumbing issues, and 2 months of complete vacancy. His actual cash-on-cash return after accounting for everything? Somewhere between 3 and 5% annually. Still solid, but nowhere near the 15 to 20% returns people casually brag about on social media. Year 10. Let us now compare. Jake's property is now worth approximately $670,000 to $700,000. His remaining mortgage balance around $344,000. His equity roughly $330,000. Over 10 years, he has spent approximately $60,000 on property taxes, insurance, maintenance, and vacancy costs. Now, Marcus. His portfolio has grown to approximately $340,000 to $360,000. He has personally invested around $148,000. Everything above that amount came purely from market growth alone. No debt, no tenants, no repair bills. Surprised? Their total wealth is almost identical, but the journey could not have been more different. Jake carries $344,000 in debt. His entire investment depends on one property in one neighborhood in one local economy. Marcus owns small pieces of Apple, Microsoft, Google, Amazon, and thousands of other companies spread across the entire U.S. economy. He could sell everything tomorrow if he needed to. At year 10, neither investor has clearly won. They have simply taken 2 very different roads to almost the exact same destination. Now, the moment you have been waiting for. 20 years later, Jake's property is now worth approximately $900,000 to $1 million. His mortgage is nearly completely paid off. His total equity? Approximately $800,000. After counting every single dollar of rental income and every single dollar of expenses over 20 years, Jake's total net worth from this one investment approximately $1 million to $1,050,000. Now, Marcus. $100,000 invested, $400 added every month, 10% average annual return, 20 years of simple consistency. His portfolio, $1,102,000. He personally contributed $196,000 over 20 years. The market gave him the rest, over $800,000 for simply staying patient. No debt, no tenants, no stress. 2 completely different paths, almost the exact same destination. Jake built his wealth through leverage and active management. Marcus built his through compounding and patience. But before you say, stocks always win, stop right there. Because the stock market carries risks that are just as real. They are just much easier to ignore. In 2008, the S&P 500 dropped nearly 40%. In March 2020, it crashed 34% in just 33 days. Imagine watching your $300,000 portfolio become $180,000 in just a matter of weeks. Most people panic. Most people sell at exactly the wrong moment. Stocks also do not give you meaningful monthly cash flow. A $300,000 portfolio might pay you only $400 per month in dividends. Useful, but nowhere near enough to replace a full-time income. And leverage? Marcus used $100,000 to buy $100,000 worth of stocks. Jake used $100,000 to control $500,000 of real estate. When property values rise, that leverage is a superpower the stock market simply cannot match. So, which one actually wins? Honestly, that is the wrong question. The right question is, which one is right for you? If you want completely hands-off and passive, stocks. If you want leverage and monthly cash flow, real estate. If you have the time and energy to actively manage, real estate. If you value flexibility and the ability to access your money quickly, stocks. The best investment is not the one with the biggest number at the end. It is the one you can stay committed to for 20 years without quitting. Because the only investor who truly loses is the one who stops. So the next time someone tells you real estate always beats stocks, or stocks always beat real estate, ask them one simple question. Did you include everything? The taxes, the repairs, the vacancies, the crashes, the time, the stress, the opportunity cost. Because the math that includes everything is the only math that actually matters. If this video changed the way you think about money, subscribe, because that is exactly what this channel was built for.